about. So I've been lucky enough to, with UBCO and Baylex being their external financial accountants right from the start. So I've been very much part of the journey that they've been under. And I think with both of those, what they both did do is come to us right at the very start, which actually was really sort of integral to making sure that we could get, they came and saw us, they had good lawyers right at the start, so we basically could make sure that we had everything in place that we needed to in order to get them to where they are today, and where they've now got sort of, you know, in-house sort of financial controller, and but I was probably the quasi-financial controller for both of them before we got to a position where we could have an in-house financial controller. So my role sort of changed with both of those, but yeah, it's been a really interesting journey so far. Oh. So what I'm going to talk to you today is about probably some of the boringest stuff, but still very, very important, is the structures that you need to consider when you are actually starting up a new business venture, and the importance of those different structures, and then actually just cover off some of the accounting systems that you know, you should be considering. Probably as part of the due diligence, definitely would stress that you should you have a decent accounting system right from the start. It's really important to make sure your numbers are actually, you're reporting correctly, and it doesn't need to be, you know, ridiculous amounts of money these days to actually have something decent. So we'll cover off a bit of that as well. So there's lots of different structures out there that you can actually use. So I'm going to go through each of the different structures for you and talk about the pros and cons of each of those structures. And then what I'll also do at the end is I'll talk a little bit about, because a lot of it is around tax as well, tax efficiency, around some of the other things that the government's just brought in around R&D tax credits. So remind me and I'll have a chat to you about that sort of at the end. So really important that you, when you come and talk to us about structuring, it's around sort of, okay, what are we going to do? What's your long-term plan? Asset protection is a big one that we sort of consider when we are looking at structuring. So it is really good when you come to talk to us about that, sort of having a bit of an understanding, like as Tracy said, your exit plan, what it sort of might look like in regards to investor raising and what you've currently got in place in regards to what assets you currently own, etc. So that we can, all of those things need to be looked at in regards to choosing an appropriate structure for you going forward. We're trying to safeguard your current wealth is basically what we're trying to do, and so that you sort of, you know, if things do go pear-shaped, you're not going to potentially lose absolutely everything. So there's a whole lot of different structures that we can use. So there's a sole trader, there's a partnership, there's a new partnership structure which has been out now for about probably 4 or 5 years, which is called a limited partnership. You have companies, which we used to have, we've got a straightforward company. We used to have qualifying companies, those have now gone, so now we can have a LTC, which is what we call a look-through company, and then of course we can have a trust. So those are sort of the common vehicles that we have in New Zealand that you can actually use. So this is actually a really good decision criteria tree that we can sort of go through. So what I'm just going to do is with this, I'm just going to go through each of these for you so that you can understand you know, what the pros and cons for each one are. So if I start off on the right with the sole trader, basically that's me operating as me personally. Everything I own, everything in my own name. Everything if I have a profit, it's going to go out to me personally. If I have a loss, it's going to go out to me personally. Generally, I mean, I've been in the game for 23 years, which is a long time. Sole traders used to see those being used. Would not suggest a sole trader for anyone these days. It used to be that companies were too expensive to use, but that's sort of with, you know, how companies can be set formed these days, would never do anything through a sole trader. It's just too risky, and you're opening yourself up for lots of risk if something does go wrong, because they basically will go and attack you personally. You then can have a company. So a company is, if you imagine, it's a block wall around you. It gives you protection. So pretty much, unless you've done something, you've been trading recklessly, a company, if the company was to go under, basically all you would lose is whatever you've put into the company, whatever you might have signed as personal guarantee. So that's one thing to be very mindful of, is when you're going into business, and time again I see this happening, is, you know, a company might get shaky and it might fall over. What have you signed in personal guarantees? Sign nothing. and it might be that you actually forgot that you signed one with Joe Bloggs 5 years ago, they'll all come out of the woodwork if something happens. So personal guarantees when you go into business, really, really important that that you understand that. And again, it's probably one of the things that would be on the due diligence checklist is understanding what personal guarantees you've actually already entered into. So companies are a great structure to be able to use. The company tax rate is 28%. But in saying that, to get the profits out of the company via dividend, like you might pay yourself a shareholder salary, but to get the profits out via dividend, you actually have to pay another 5 cents. So effectively, it is 33 cents in the dollar. With the company, especially when startup, you're probably going to be in a loss position. So with that, it means that those losses actually get stuck in the company. So they get stuck in the company, and then if you get diluted too far, which is why another reason why we're constantly watching the dilution of the shares when investors come in, we can potentially lose those losses. So if we sort of go below sort of 50% in our dilution of our shareholding, then we might have $400,000 worth of losses sitting in there. They can be lost overnight, if depending on our planning of our equity raise and that. So got to be really careful around all of that, because that 400,000 of losses is 400,000 when we start to make profit, that we're not going to be able to use to offset that profit. So we're almost getting double taxed if we don't manage that process and that. So then we get to what we call a limited partnership. So what that is, in fact, no, I'll cover off partnership first. So a partnership is a little bit like a sole trader, where it might be myself and Tracy are in business together. Again, it's like if we get attacked, we get attacked personally, because we might as well be a sole trader, but it's just I've gone into business with somebody else. So there's two of us rather than one of us. Again, marginal tax rates apply. It has to get allocated out to Tracy and I. We don't have a choice. If there's losses, it gets allocated out to Tracy and I as well. So it's very much like a sole trader, but there could be 2 or 3 of you in that position. Limited partnership, that brings in the good parts of a partnership and the good parts of a company. So a limited partnership is a new vehicle that sort of came in probably about 5 years ago now, maybe 6 years ago. So it gives me the protection of a company. So from the outside world, I look like a company, but from a tax perspective, the losses and the profits flow through to the shareholders or the limited partners. So a limited partnership has basically sort of 2 sort of forms of people involved in it. They have what we call a general partner, which is a company, and then we have limited partners. So I might be a limited partner, Tracy might be a limited partner, Bill might be a limited partner, and I can have basically as many limited partners as I like. So I have the protection of like a company, but the profits and losses flows through to me. So if I've got a 30% stake in the limited partnership, so I've introduced 30% of the money into the limited partnership, then I get to enjoy 30% of the profit and 30% of the losses. It is limited, and you'll sort of see it is limited up to what I put in. So I can only ever take out up. So if I'd put 300,000 in, I can only take out, have losses up to 300,000. So that's sort of the limitations of it, but it works really, really well. It also works really well if you're going offshore. Like limited partnerships work great if you're going, say, into Australia, is where we've seen it work really, really well, because basically if you're going into Australia, you don't get double tax. You basically end up effectively paying 33 cents in the dollar, where if you used just a normal company going to Australia, you end up paying basically 66 cents in the dollar. So if you're planning on growth strategy going offshore, a limited partnership can be quite useful. But in saying that, for equity investors coming in, it is a more complex structure for them to understand, where they might not quite like it as much. So it's good if you know sort of the people that are going to be investing with you, because they can understand the pros and cons of it. If you're going to sort of go out to sort of an angel investment group, it is a bit more of a tricky vehicle for them to understand and maybe put in place, but it definitely is a good structure in regards to giving you the best of both worlds. Most of the companies that we're looking at the moment probably have the company structure, because it's just been a simpler structure for them to use from an equity raise point of view. But say when we start to go offshore, it might be that we somehow add on a limited partnership sort of sort of structure so that we can sort of be far more sort of tax efficient when we're going offshore, etc. We've then got a look-through company, which basically is our new form of qualifying company, because qualifying companies sort of died a death sort of a few years ago. So a look-through company has the same sort of benefits of a limited partnership in that it's a company, the profits and losses flow through to the individual owners in the same way as what you invest. So if I invest in, if I put 300,000 in, or I've guaranteed a loan of 300,000, then I can get losses to flow through. That's up to that point, and only up to that point. But the downside of a limited LTC is I can only have 5 investors. So it pretty much has come about for property investors, is what a LTC is actually used for, because generally you have less than 5 investors. But that's where, as I say, I would be, if I was looking at it, I'd be swayed more to having a limited partnership than an LTC for the innovation space. And then you've got a trust. So a trust is basically another legal entity. Probably for the innovation space, it's not something you would use. You might use a trust to own your shares in the company. So that's a common, it's a common thing that we see, is that rather than me owning, say, 50% of the company myself personally, my trust might own that 50%. And that if I was just a standard straight company, I probably would do that. I'd have my trust, because then when I sell it for 50 times, like Roham's hoping to do, that wealth that I've created, because again, remember, it's about asset protection at the end of the day, will not go into my own name. They'll actually go into the trust name. So I might have only put in $200,000 of my own money, and now it's worth 50 times that. I don't want that to come into my own name. I actually want that to go into my trust, so that's actually fully protected. So that's where your ultimate ownership can be a trust, rather than you actually own your shares, say in your company or your limited partnership personally, is actually have a trust sort of sitting there as your vehicle, or at least owning maybe 95% of your vehicle, and then you might just have sort of 5% in your own name. So those are the structures that you actually can use in New Zealand. They're all quite sort of different. This is a really good slide, and I can actually send this to anyone that I did print them off, and I left them in my office in Tauranga. A really handy place to have them, because it does actually show you the pros and cons of each one quite sort of in a real simple way, and you'll see as well a trust rate is 33, but in reality, a company tax rate is 33 as well. Has anyone got any questions around that slide? No? Has anyone seen limited partnerships out there working? A bit more expensive to set up a limited partnership than a company. So if I'm sort of looking at formation, probably a company, you can do that anywhere sort of, if you get someone to do it for you, because it's important that you have a constitution, because you can form a company on your own right, sort of just go onto the Companies Office site, but generally that won't give you a constitution. Really important that you do have a constitution, because when you go through your due diligence, that's something else that they're going to look at. What does your constitution currently say? So it's anywhere between $500 to $1,000 to set up a company. Limited partnerships, more than that. You're probably looking at, when I first set our first one up, it cost $50,000 to set it up. But they've come down in price since then. It's like anything. New toy, it's always way more expensive. You're probably looking to set up a limited partnership now around sort of the $4,000 to $6,000 mark. Predominantly it's the lawyers that will be setting that up for you, and that, but it's a much more sort of common vehicle to use than what it used to be. Like I say, it used to be a very expensive structure to use. And that partnership, again, I actually wouldn't really suggest a partnership or a sole trader. Just don't even, just those are entities that you just wouldn't use any longer. Look-through company would be similar cost to a company. There's just one more step that you need to do with a look-through company, and that's actually apply to the ID to make it a look-through company, and you sort of need to do that right when you set it up. You can't sort of do it, well, you can, but it costs money. You can't sort of do it after you've sort of, down the track sort of 2 years and say, oh, I wish that I had actually made that a look-through company, because then you've got to pay an election tax to actually come in. So you're better to get your structure set up right from the start, so that you don't have these issues to have to deal with. So then I've actually just gone through here, so I've actually just talked about all these things. So we'll just go through to, actually just go back here for a minute. So here you'll see as well, one of the other things to When with a partnership, which is why again I wouldn't use it, if somebody leaves, you have to start a whole new partnership. So it's like it's died and you have to have a brand new one. So again, reason why I just wouldn't use one of those as a structure, and very limited to planning. Companies, we talked about as a separate legal entity, limited liability. So with this as well, with the companies, you do need to understand that there's directors and then there's the shareholders. So the directors basically are running the company. So it might be that Tracy and I are the directors, and Gail could be, we might be the directors, but Gail's actually a shareholder with us as well, and we're all the thirds. But she's got no sort of control around the company. So it's Tracy and I that are making all the decisions, and Gail's just sitting there as a shareholder. So if something was to happen, if say Tracy and I were trading sort of recklessly and doing stuff that we shouldn't be trading insolvently, it would be potentially us that would be in the gun. Wouldn't be Gail, because Gail is just sitting there as a shareholder and not sitting there as a director. So the directors are the ones that are sort of accountable at the end of the day. Gail could still lose her money because she's put in the same amount as us, but as I say, there are different hats, and you need to be aware of those hats. Which hat are you actually wearing, or even when you're making decisions, which hat are you actually wearing, because it's really important distinction between those two. This doesn't really apply to you guys, but the attribution rules does apply to companies where, say for example, I was earning all of the income. I might have signed an agreement just to have a management fee from somebody else, and I get all my income from one source. The attribution rules would kick in if that was the case, so I actually would have to, even though I might have myself in there and my trust in there as the two shareholders, I might have made a profit of $150,000. If I've got all my income from one source, which might be, I've engaged to do a management agreement with Gail, so she's going to just pay me all of my income, but I'm doing it through a company, then basically all of that would have to come out to me personally. Even though I've got a company and I could be using a tax rate of 28 cents, can't do that. The attribution rules would kick in if more than 80% of my income comes from one source. So that's just something to be aware of with the company.
Well, what happens if the company that you're charging the management fee to is an international company? Say if you've got a company in Hong Kong.
Still, if it comes all from one source, the attribution rules still kick in, unfortunately. So the aim of the game is to try and not have less than 80% coming from one source, sort of break it up. And that rule came in when the tax rate came down in New Zealand. The top tax rate came down to 33. That was something the government put in to sort of stop people going, oh, let's have a company, because the tax rate between individual and the company is different. So that was sort of why they did that. Company's way easier to introduce new shareholders. So from a due diligence point of view, way easier for them for us to have new investors than it is in anything else. As I say, in good tax planning, you do have the timing difference between the 28 cents you pay and when you pay a dividend out. So that 5 cents, even though you do effectively pay it out, it is you do have some advantages on when you actually want to do that. So again, limited liability, it's treated like a partnership, so it flows through. You only can be individuals if you're a look-through company. You can't be a trust. Maximum of 5 shareholders. And again, as I talked about the loss limitations, you can only get out in losses as much as you've actually put in. And then there is some quirky things. If you sell some of your shares, it's basically we have to do a calculation around sale of book value, and it just gets really complicated, which again, you wouldn't want to do for angel investors coming in, because it's going to just create some tax hiccups that you potentially don't need. So then we talked about trusts. So this is really good for the ultimate owner of, if I've started up a company, I know that I'm going to be doing equity raise, but I want to protect whatever my shareholding is in that company. This is where trusts are really beneficial for this. So the key thing to understand there is that in a trust there's 3 different sort of hats that are worn as well. There's the settler who actually sets up the trust. Then you've got your trustees who are a little bit like your directors. They basically make all the decisions in the trust, so they manage the trust assets. There's lots of commentary at the moment around trustees, and trustees actually taking more responsibility around being a trustee. You've probably seen it in the papers. So it is something to take really seriously. Like, people used to say, oh, Gail, you're my mate, would you like to be a trustee for me on my trust? if you get asked that question, say no, because the responsibilities for trusts are a lot more now. You really want somebody to be coming on as a trustee that really understands what they're taking on. So the days of your friends actually being your independent trustee have sort of gone by the by, and most people shouldn't. If a client comes to us and they want their friends to be their trustee, we will advise them to, either get their lawyer or their accountant to be their independent trustee, because they're the only ones that are going to actually understand the responsibilities that they're taking on. And then the beneficiaries are basically who's going to ultimately receive the wealth. So I could actually be the settler, I could be the trustee, and I could also be the beneficiary. So it's really important to understand the different hats that I'm wearing. And in your beneficiaries, you might have children. You can basically have whoever you like as the beneficiaries, and that. But it is a good way to have your ultimate sort of gain. Because we're going to have that big multiple come through, to have that money protected from day, rather than it go into my own name. I could gift it off, but by having it ultimately protected from day one, it just means that the protection is there, and they're under our sort of current laws in New Zealand. And so this is just legal representation, trust continued. So we talked about independent trustees. So it is a really good tool to use. We then talked about the different kinds of people involved in a trust. So we've talked about the general partner. So that's actually a company, and that's what the outside world sees. So they actually just, from the outside world, it looks like a company, it smells like a company, but it actually isn't. And then, as I say, so that's what the public sees. And then you've got your limited partners, which basically are who's put money into this business. So I might have put 300 in. Tracy might have put 400 in, so she's got a bigger stake in it, and Gail's put in 200. Those are the limited partners within the limited partnership, and we get to share the losses or the profits based on what we've actually put in. It is a separate legal entity, but the general partner carries on all the risk and all the liability on our behalf. And as I say, it has a flow-through treatment for profits and losses in the hands. So those are the structures. As I say, there's some really interesting structures out there now, which is really really good. Before I go into the accounting systems, I might just talk about the R&D tax credits, which is new, that's come out as well. So that's basically effective from the 2016 year. So if you've spent money in the company on R&D, especially in internal labour, and it's over 20%, then potentially, so say my R&D costs might be 200,000. If I can quantify that, then potentially I'll get basically a tax credit back of 28 cents in the dollar on that 200,000. So rather than me actually have to have that sitting there as a loss, I actually can apply to IRD to actually get that back in cash. So it's actually and it's a brand new thing that's come in effective for the 31st of March 2016 financial year, that if I've invested in R&D and I can substantiate it, then the chances are I can actually get a tax credit back in cash for that R&D that I've spent. So it's the 2016 year that it's the first year that we can use it. So you have to apply to the government first, and then when you do your accounts, then there's sort of the devil's in the detail. It hasn't come out quite yet, sort of a detail of how we actually apply for it. But if you go and look on the IRD website, there's a whole full area around sort of seeing whether you're eligible for it, and then basically there's going to be some calculators there around sort of how that will all work, etc. So when we do the account tax returns for the 2016 year, we'll be looking at our companies that are in that innovation space to see whether, one, if they're eligible, and two, what we can probably look to claim back. So it's going to be retrospective for the 2000s, because you can't really make the calculation until you've actually completed the financial year. But it's a great thing, because it does mean rather than those losses get stuck in the company until we've actually earned profit, which is, Tracy said, is cash is king right now, you actually get that back.
Oh, it's a loss, right? If you were making a profit in there.
Oh yeah, if you're making a profit, no. So it's only while you're making a loss, you can actually use that. The answer that I haven't been able to get at the moment is if we're getting Callaghan funding, because quite often if we have R&D, we're getting Callaghan funding as well. I haven't been able to get an answer out of IRD or our tax experts yet. Will it be the net of those two, or will it be on what you've actually spent? So my thinking is it probably will be the net, but that's sort of something we're investigating sort of at the moment, because you're double dipping, exactly. So I think that it will be, but as I say, we're just waiting to get sort of the detail of it from MyID. Like, they haven't actually released the full detail on how it's going to work. Sort of, it's just sort of the nice to see stuff at the moment. So now what I'm going to do is just cover how we're going for time. Accounting system. So I've been around a long time, and you know, when I started, to have really good accounting systems, it was going to cost you a lot of money. Doesn't need to now. You know, the Xeros of this world, which, as I say, have a huge multiple and haven't made a cent yet. You know, they've just changed the whole accounting world in regards to how easy it can be to get really good integrated accounts, as Tracy sort of said. You know, balance sheet and P&L. Really important that we have both of those. And it's just a really good way of you to be able to keep track of, you know, Tracy was talking about the milestones and keeping track of, this is how much we've budgeted to do for this milestone, how are we actually going with that. The accounting systems like Xero, MYOB and Reckon, which used to be QuickBooks, are great systems that you can use online in the cloud to actually help you to understand that, because with due diligence, the better you've got in the better accounting system you've got and what you've been able to show in reporting against your budgets and how that's going. So we haven't got sort of, you know, we've got the hockey stick, but we're nowhere near that, is really important from a due diligence point of view. And one thing that we see a lot of is they might go with the accounting system, but they get no training. So then they actually aren't using it properly. I mean, these systems can do some amazing stuff with you. You know, they can connect to a CRM system, so you can keep, you know, track of who your customers are, who you've connected with. So if you're validating your market, all of that can be captured in, you know, in the system right from the start. Bailix is a prime example. They went to the boat show. They captured data of every single person that came to see them. So that their database is just massive in their CRM system of potential people they could sell the boat loaders to. And so they, right from the start, we you know, spent time in actually making sure that they had a really good accounting system, and we had the right add-ons with that as well, which is where I think Xero's done a really great job, because there's so many add-ons that you can actually just you know, bring into Xero to actually, as the business grows, to actually make it work really, really well. But getting training on exactly how it works rather than down the track, I think is well worth the investment.
Any idea how many hours you're talking to Xero?
Oh, Xero, not many. I reckon to start off with maybe 2 or 3. Yeah, and then, as I say, and then you sort of learn that, and then it might be down the track you might need to understand a bit more of how it works, but it doesn't have to be massive. And that, you know, an investment of, you know, $300 to $500 in training, really valuable, really, really valuable. And as I say, you can do your projections, put that in there as well, and then be tracking how you're, you know, going versus your projections, which you're going to need not just for your angel investors or equity investors, but also for the bank. Now, banks is a really interesting sort of scenario. Is, you know, we'll get our investors, but then we also need to partner with the bank. And so what I would suggest you do is actually really go and talk to the banks around who's got appetite for innovation. They all do change and that, but really important that you partner with the bank that's going to get the innovation space and are actually going to support you through that, because time and time again, Tracy and I have both sort of seen who we think we're going to partner with might change because their risk appetite has changed. So you really want a bank that's committed to the long journey and not just there, you know, for 5 minutes. You want them to understand that, hey, we might not hit our milestones. So we might have this funding which, you know, they've given us, and that's on certain milestones that we have to meet with them or covenants. We might not hit those. But for them to understand why we haven't hit those and actually still want to be with us and not sort of pull our funding, I think is really, really critical. So there's a few banks out there that are great at understanding the innovation space and actually want to be in it, and there's other banks that just won't touch you. So really shop around when you're looking at partnering with the banks. Quite often the banks that get it, a bit like sort of the angel investors as well, they'll follow the people. If you've got a really good team, they'll follow that. As much as what the idea is, it's the people that they believe in that they'll actually put their money where their mouth is and support you, which I think sort of comes back to, you know, what Bill and Tracy were sort of saying is how important it is to get that good team around you, because that just backs up everything you're doing and just validates you out in the market that, yeah, the people sitting around this table have got what it takes to actually take this company where it needs to go. And quite often that's where you can actually use your external advisor, because they will see who actually gets it out there in the market and say, is the person more than the banks? Quite often is get them to actually say, who should we use? I'm not gelling with this person. Who do you suggest we actually go to in the market that actually will get it? Baylex was a really good example. We went around all the banks and we actually interviewed all of them and put the same pitch out to them. So with angel investment coming in, we couldn't have any personal guarantees, so that was a big issue for finding a bank that would support us. Pretty much, so we went to 4 banks and only one came back and got it really, and got us the deal that we actually wanted on the table.
That's down to personalities, aren't it?
Yeah, well, 3 of them still just were like, we're not going to do it unless there's personal guarantees, and we're like, nah, we're not doing personal guarantees. So, but we did have a good personality from the bank that did bet for us, and they still are in their betting. And the big critical thing as well is communication. Like, if I think of Baylex, they just talk to the bank on a regular basis. You know, this is where we're at with our milestones. I mean, that's what we love about Xero. I mean, all the cloud stuff really is, I can be on the phone talking to the client at the same time. We can be looking at the real live data. So when you have a meeting, it's there, it's current. It's not like you have to sort of go, have you got this in or not? You can actually dig down and actually look what it's like. But I think the communication thing is just massive with whoever you partner with. From an angel investment point of view and from the bank, is just, you know, keep them informed about what you're doing. And even with your creditors as well. I mean, you know, when you go through that, what did you call it, that gap? The void. That don't be scared to, you know that you're basically going to get there, but there's just this gap at the moment that's really hurting, is talk to your creditors and that, hey, can we just defer your payments? Don't be scared to actually have those conversations, because most of the time, as long as you're upfront with them and then you deliver on what you say you're going to do, they'll support you. They'll totally support you through it. And in my experience anyway, that's what I've sort of seen. So it's all about the communication with everybody that's involved in the business. Really important that, you know, you're upfront and honest with them and keep them informed. And then pretty much, you know, they will be there and support you as they can. So sort of just some general tax tips, but just general tips to take away is, you know, as Tracy said, make every dollar count. You know, the runway is the runway, and you get to take off way sooner than you think, and you have to go back and get more money. And you know, don't be scared to spend some money up front to get some good professional advice. I think that's probably time and time again where I see businesses fail, where they just haven't done that. And it's because they haven't got a lot of cash, and understand that. But come and just talk to some, you know, quite a lot of people in this space, like lawyers and accountants. We want to help these people as much as what the angel investors do to help them succeed. So, you know, we're prepared to sort of help there and see if we can find some funding to even, you know, help with that. Structure correctly, because it's way easier to structure it right from the start than for us to have to restructure down the track. Again, doesn't look good from an IID perspective. Why are you restructuring? Costs a hell of a lot more money to actually do that, and it's just far better to get it right from the start. Accounting systems, to say, get training and get it set up right from the start. And just, be careful about, you know, what you're spending your money on. Just really maximise that dollar. That $1 needs to go to be like $2, basically, because that runway will sort of come before you know it, and you'll be back again having to raise funds, and then that all just takes time away from the game of what you're supposed to be there doing. And automate as much as possible. I think the more you can automate it with, you know, the Xero and your add-ons, it can basically be a person, if you get it right, and you know, get some advice on how you can automate it. Really, really important to do that. I think even just with Xero alone, it frees up your admin person by at least 30%. It's amazing, and it's absolutely a great program, and so is MYB and Reckon as well. You know, you've got your phones, you can be doing a little bit while you're sitting there waiting in the airport or waiting for a meeting, because as an innovator, time is as precious as money. You don't have a lot of it, so you really want to make sure you're, you know, using it wisely and not sitting around wasting time because you're waiting for something. But thank you for listening to me.